so quiet.
It's the deep breaths before the plunge.
I don't want to be in a battle. But waiting on the edge of one I can't escape is even worse.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, July 8th, 2022. The S&P 500 is currently sitting at 3,888. I'm here with Ian Bo Cruz McMillan and Dan Series 65 Gorkuber. I'm David Zarling. Plenty to cover this week. It's great to be back on here with you guys. Where should we start? I mean, are we just going to start with talking smack about Kevin while he's out of the office, or are we actually going to provide some great info?
Bachelor party Kev.
Right? Is that what he's doing? He's his bachelor party this weekend?
I believe that.
I know he had mentioned it. I knew it was coming up, but he never reminds us of these things. He just kind of sneaks off.
Yeah, I mean, it's either that or he's being highly productive. Like, he fixes plumbing during the holiday weekend, so I give him a lot of credit.
Well, I'm sure that had a lot to do with his wife or his fiance.
Right. I'm sure. Yeah, we have to get that drain fixed, honey. The honey-do list got done. Proud of him. Anyway, Kevin, we love you. Glad you're out of the office. But what's the environment we're in here, guys? Plenty of information from the market, but also at the same time, undecided. It's the beauty of getting data on an ongoing basis. Where do you guys want to start?
Yeah, I mean, it looks like we're going to have a decent week for equities. I mean, I don't think it really changes much, right? I don't think we're going to end up above last week's highs.
Well, it's similar to 2 weeks ago, right? Like,
yeah,
we talked about 2 weeks ago that really this is any price appreciation.
Just still stuck here at 3,800, 3,900, whatever you want to call it, which is, I mean, a decent behavior level. I guess we stopped here for a little bit, kind of March 2021. So, well, I take that back. Well, we know the average stock stopped going up in March 2021, right?
Yeah, February and March 2021 is really when we started to see the correction. When we look back, right? And that's what we look left on
S&P
charts.
kind of just kept chugging.
Yep, S&P
because large cap growth kept chugging.
But at the same time, all the previous high flyers rolled over, and the S&P followed starting this year. We continue to see lower highs and lower lows. Very definition of a downtrend. We continue to see downward sloping big moving averages. What do I mean by big moving averages? Like a 200-day, a 50-day. What are we at right now? Like, are we near a 20? I believe it's a 20-day. But all of these moving averages are falling. When we look,
I guess we crossed back up above a 20-day moving average yesterday.
Okay. Yeah, using something like S&P, I assume.
Yeah. Still below 50.
And here we have, just to paint the picture, from their highs, and these highs can be anywhere from February of 2021 to October, even January of October last year, January of this year. You have NASDAQ 100 down 28%, small caps down 27%, something like a value line geometric, which kind of gives you like this mathematical, like what's some of the average stocks doing, minus 22%. All world index minus US stocks minus 23, emerging markets minus 30, frontier markets minus 27, and then all the high flying names. And this is where I kind of want you guys to jump in here, because something like, and this is not to hate on the product, but something like an ARC Innovation down 70% from its high currently, but it was lower before, correct? Like, we've seen how much of a rally here in something like that product, but we're still down 70%. Isn't that up like 30% or something?
Yeah, we've kind of been trading this range for what? 2 months now. It's kind of established a range for ARC, and it's, from the bottom or from the lows of the range, call it like 35 and a half. Now trying to kind of take the top end of the range here.
Yeah, 35 up to 45. I guess we got to a high, intraday high, almost got up to that 50, 49.50. We'll see. I mean, it's still a downtrend, really hasn't fixed itself.
No, but it just goes to show that something down 70% from its high has been in this range. It's a 30% range going back to May. And it hasn't, like you said, it hasn't fixed anything. Same with IPOs, same with software, same with SPACs. And so we continue to be in this environment. There's no doubt about the environment. It's a downtrending environment. Some people call it a bear market. All we would say here is it's lower highs and lower lows, downward sloping moving averages. Now we're just looking for, does it continue, or do we stabilize and eventually the rate of trend changes and we can stabilize and support shows up here? And we could talk some about those levels in the extended portion. But really, downtrend remains even with this week, downtrend remains the theme or the thesis that continues to get confirmed. What else? What other things you guys want to talk about from this week to highlight for our clients and anybody else listening?
I'd say we talk about credit spreads a lot on here. That's something that certainly hasn't turned around for the positive.
Those continue to move higher for sure.
Income, we had a decent rally attempt in fixed income. And I guess it started last week, really, I guess a couple weeks ago. And TLT back up above that 115 level, which has been 114, 115, pretty important level over the last few years, really over the last 8 years. And that got slammed down real quickly. Quickly. I mean, bonds or TLT again over the last 3, we'll call it 2.5 sessions, down 5%.
Yeah,
which is a lot. That's a big move for fixed for something like U.S. treasuries. Junk a little bit better over the last 3 days. So is that some type of divergence? I don't know. We'll see.
Well, it just goes to show that you can't just marry an asset class and put it in and expect risk parity to work. And what I mean by risk parity is that there's some type of offset when, for example, when equities go down, the traditional portfolio construction would look like you have 40% bonds, and that kind of cushions that, offsets that. We're not really seeing that. And we've harped on that many times on here, but we continue to see weakness, even internationally. If you look at something like iGov, which represents international treasuries, continues to be weak. Lower lows, lower highs, falling moving averages, breaking important levels. And
golly, and you look at this behavior, this is just, you want to talk about just waterfall type of movement.
Yeah. Well, Dan, do you have anything for, I kind of heard you there, fixed income or credit, or do you want to go to commodities?
No, yeah, I think, just kind of the point of kind of piggybacking off of what Ian was talking with just seeing more of the, yields in general, just kind of sticking firm in this range, and then really just seeing like that divergence, if you will, on high yield versus high yield corporates, I guess, versus something like long-term treasuries. Munis really haven't done much this week. They were kind of high yield munis really stood firm here for a while. Just using something like HYD, but really this week it hasn't done much of anything. So Dan, are you comparing HYG or HYB versus something like IEF, which is a shorter term treasury? Are you going versus a longer term, something like that, which we are seeing, I guess, if you look at it, a little bit of a,
even if you like HYMB too.
Yeah. Yeah, I'm looking more like HYG versus TLT, but I mean, any one of those is gonna fit the bill. So,
Right. Nice play on words there. I appreciate that.
Yeah, I mean, that's not a bad move in junk versus treasuries.
Yeah, which is and what we're describing
risk
here
on.
is a ratio, correct? A ratio between high yield and something a little more conservative like a treasury, and seeing relative strength at a high yield. That's a risk on.
Or the market just thinks that corporations are more likely to pay back their debt than the U.S. government.
Ooh, controversial.
Yeah.
Controversial.
I mean, isn't that kind of what this is saying?
A little
For
bit.
sure.
A little bit, yeah. I mean,
I'd agree with it too.
I mean, is that what the market's saying? I'd rather own Apple corporate bonds than intermediate term treasury, like U.S. Treasuries,
Well, and I'm sure
because I feel safer.
if we're all putting on our crazy macro fundamental hats, which I'm not a fan of, that probably has a little bit to do with dollar.
Yeah, let's talk about the dollar. I mean, you want to talk about something now? Of course, yes. We're sitting here today. Today's daily candle is not the best thing I've ever seen. We'll see where it closes, but
weekly ain't bad though.
I mean, Dave, we go back to this pot. I mean, we talk about, and I remember this. It broke above
103, 104.
No, I'm going back to November when we broke out of this base above 94.
Oh, yeah, yep.
So that gives you a target of 103, 104, which sounds absurd, but I mean, that would be based on the chart. Like if we're going to go back up to this kind of range we've been in, we get to 103, we get to 104. And now we've just continued to bust right through, sitting. I think we were in the 10. Yeah, we sit at 107 spot.
09.
I mean, 107 spot 8 this morning at the highs.
Well, and we got this range that goes back to 2015. Really does
the
target.
Weekly candle is.
Yeah, the weekly candle is dynamite, and this really targets 120.
I mean, 104 is a big level, even going back to DXY. The 90s.
Yeah.
Yeah.
There is something here regarding dollar strength, and we'll see. We'll see how this plays out. I know in the extended portion, we'll talk a little bit about the euro, but there's definitely something here with the dollar, which impacts everything, right? Why wouldn't dollar price movement impact other things? But what are we seeing out of commodities? We talked equities. We talked a little bit about bonds. Commodities had been such a great differentiator for us, for our clients in the first part of the year.
And I mean, February and March.
Yeah. January, February, March. Great.
Then there, like, I think you had a great comment yesterday on Twitter. So you go back to February, March. We're involved in, these commodities and industrial metals. And I don't know. I mean, right. I didn't know why at the time, other than they were just ripping higher. Then into February, Ukraine and Russia get into their tiff, right? So then that was the thing for like 3 or 4 months is, oh my God, the inflation. But if you go back and look at all these commodity charts, I mean, they peaked almost right around that time, if not like a week late. I think a lot, I would say, peaked first week of March, maybe.
Well, that's
and
right.
Now a lot of them are down below where we were when this whole quote unquote war started.
Right.
Grains have just.
Yeah, everybody was piling into energy and agriculture because, right, the Russian invasion of Ukraine, whereas price moved first. So I'm going to tell you that the market knows more than we do, and that the price appreciation you saw in those things heading into that, did they know that there was some type of thing taking place? I would make an argument, yes. Does that mean some type of nefarious inside information? No. But commodities moved, and since the invasion,
all of that moved earlier.
Right? It moved earlier. It moved before the Russian invasion. And now, if you bought oil and grains and
right, if you came into Q2 or Q3 with this thesis about like inflation and what it's going to do to commodities, I mean, you've been torched.
Right. You were too late.
Yeah. Isn't
So
that
it's interesting.
fascinating?
Yeah, we're seeing stocks down, bonds down, and now commodities down. And
What cycle does that put us in, Dave?
puts
Like
us
what
in
part?
stage six. Yep, which is
Woo.
contraction. And we'll see, though. I mean, there's a little while there where maybe we're going to see bonds appreciate, but the last 3 days have kind of evaporated that thesis for the time being. We're always open to that. Different thesis is getting confirmed, and it's not just domestic. Dan, we're still seeing weakness internationally too. I mean, you consider dollar strength.
Sure.
There's pretty big inverse relationship there.
Absolutely. I mean, a little bit of uptick here the last couple of days, but the overall trend just absolutely.
I mean, look at emerging markets. I think you brought, one of you guys brought this up earlier the week. I mean, what would EEM look like without China doing what it's doing?
Oh, yeah.
I mean, think about that. That's 40, what percent? I mean, it's a ridiculous amount of
the exposure.
China, the exposure, and which has been, pretty good, especially these tech and discretionary areas. China's up 32% off its lows from early March, mid-March, and EEM is down 2%.
Yeah, with the other constituents being like Latin America and India. Your point is valid. That, and there's some. I shouldn't just limit it to that. There's some other. There's some Pacific Rim stuff over there. Yes, but yeah, Latin America is hugely dollar sensitive. We just talked about dollar breaking out. That's going to have ramifications. We'll see, though. If you look at something like the Bovespa representing, Brazilian equities in its domestic currency, the Brazilian real, you highlighted that this morning. It's hovering right around 100,000 on its index, and that's a really important level. And we'll see if the dollar weakens there, that helps bring that back. But right now, with this dollar strength, it's definitely guilty until proven innocent.
You hear that? Do you hear that noise?
What is it?
That's the sound of clients running to look up the Bovespa index. And they're going to draw their lines at 100,000.
As they should. Right. That's where there's supply and demand dynamics that go back. I mean, all the way 2020, you're even more. So we'll see. We'll see where that ends up. But your point is valid. Without China, emerging markets would be worse off than they have been. Does that mean we're buying China? Not sure yet.
I mean, if we come out of this, we were involved with it for about 4 days.
Right.
And then it's since fizzled out, right? It hasn't really gone anywhere now for like 2 weeks. Kind of took the small win and now maybe rolling over. I don't know.
That's good.
Not enough evidence right there.
I love that phrase.
Yeah. I don't know. I mean,
we don't know.
We'll see if it continues.
But there's plenty of weakness overseas in equities. And this goes back to, I keep coming back to portfolio construction. The industry at large, and this is a generalization, this is not everywhere, but we are definitely in the minority when we don't have to own international stocks because that's what we should do. We don't have to own bonds because that's what we should, quote unquote, be doing, because we have the data that shows us when there's too much risk in those areas that we don't need to participate in them. Cash is a position.
Well, I mean, you look at the EFA index that has had zero bounce, while U.S. equities have put in a decent little rally over the last, couple weeks.
Well, and for context, I mean, EFA, MSCI EFA, representing, Europe, Asia, Far East, is back below its where the breakdown now, not COVID lows, but where the breakdown happened in February 2020.
Oh yeah, way below. I mean,
oof. It's 24% off its highs, and it has what technicians would call Potentially a failed
Same
breakout
spot
above 74.
Same spot it was at in
October.
July 2006.
Yeah. Yeah.
So there's your foreign developed equities over the last 2 decades.
Yeah. Pretty
Congrats.
brutal. Yeah. And that's why you don't just marry modern portfolio construction.
Congrats. That's part 30% of your portfolio because, diversification. All right. Okay. I'm off the soapbox.
You're good. You're good. Dan, talk to me about seasonality. Seasonality being like, what are the tendencies of equities in this at this point in time in the year?
Yeah, seasonality's giving us more, say, positive light here to the upside. Just on, if you look at more of like a midterm political cycle that we're in right now for the year 22, July, like this early July, mid-July into, I want to say like that August timeframe. I don't have the exact date on me, but we do certainly see some more favorable seasonality, but kind of like, we kind of touched on it last week that, seasonality this year has really been tough to get a gauge on. Now we certainly are starting to see, some of that correlation kind of line up, this week. But as far as like 2022 being, a seasonal, like marrying the seasonal front, I would say, I don't know, would you guys agree? It's kind of been lackluster,
right? And that's information. And what I mean by that is, if you have a period of seasonality that's quote unquote supposed to be positive. So I'll use this example. If you have a flight that's supposed to leave at 8 a.m. and it's 10 a.m. and that plane is still on the ground, there's something wrong. Same with seasonality in markets. For example, the mid-February through almost end of May period for this year was quote unquote supposed to be higher. And we saw weakness. We saw equity weakness, and that's information. That's when we want to pay attention. Oh, there's something not quite right here.
I will say, looking back on, if we think about the 3 kind of beginning, well, I guess one of them is kind of the end of the year. But so if you think about Santa Claus, so we're thinking about 20.
Yes.
So Santa Claus rally was bearish, right?
Mm-hmm.
Or was it? What was Santa Claus rally?
Well,
it was bearish. It was bearish in 2021, right?
Yeah, you have Santa Claus.
Into 2022. But
Santa
then the 2 January ones, one I can't remember. I know for the 2 of the 3 ended up being bearish.
Right.
I want to say January barometer and then first.
So first 5 days.
First January, 5 days, yeah.
January barometer and Santa Claus rally. And yes, we know there's overlap in there. But to Ian's point, January overall was negative. When you look at the Santa Claus, the first 5 days of the year, negative. So 2 of the 3 negative. That how prescient was that? Again, this is not about predicting. This is just about noticing when seasonal trends don't show up. It's about that plane still being on the ground. It's about when you are trying to grow some tomatoes and the tomatoes don't show up at the right time. It's the same thing in markets. When you see weakness when there should be strength, you should pay attention. And that's what we saw this year, looking at the period of.
And what day did Santa Claus rally end on? Technically,
well, it's the second business day, second trading day of the year, I believe. And we're allowed to be wrong on this. We're flying by the seat of our pants
so
on that.
That was the 4th. And then the 5th was, fourth was the top. 4th was the top.
Yes. And so Santa Claus rally positive. Yeah. Santa Claus rally positive. But the other barometers, seasonality
You're
negative.
Right. Okay.
And I know Phil Hirsch would educate us on this even further, because he's done all the work on this, and his father too, from Stock Traders Almanac. But the point is that when seasonality, quote unquote, should be strong and it's weak, we need to pay attention. And we've seen 2 periods like that. The one that Ian's highlighting with January. In addition, when we look at March through, let's call it May, that's a seasonally strong time and the market's weak. And here we are, end of June, into mid-August should be strong. We'll see. We have to wait for the data to come in to
It
see.
should be. I mean, and I think, like I've said, this time, this quote unquote bottoming process, whatever you want to call what's been going, like those, whether, some areas have rallied, some are building more bases, some, it's, overall, we're going to call it a short-term bottoming process. There's the most evidence, right? We've on this quote unquote bottom attempt, there's been more bullish divergences in breadth. There's actually more individual, like when we look at the individual names. So when I mean divergences in breadth, looking at, moving averages, things like that. The individual names are better. So there's the most potential here to where I think this could be like the best rally we've seen so far. I think the one earlier in the year was like 11%. I was looking last night, we go back up to, a 15% rally takes us back up to that 4,100 level where we peaked out before.
And that's very possible. We could have the main picture being downtrend, the main picture being
but
correction.
This could be this could be really the one that gets people licking their chops, and then thus the rug pull is
right.
Also the most epic that we've seen.
And so we could see equities move higher into mid-August. And I don't want to sound so negative. We're going to talk about some price levels we'd love to see reclaimed in the extended portion that would deny that thesis. Again, we operate in thesis. We have the facts of price. We use that to confirm or deny what the thesis is. So a thesis of further downside is something that we want to pay attention to what happens here seasonality-wise, although keeping in mind that further weakness after mid-August would be perfectly normal and match a volatile midterm, big picture-wise, midterm election year volatility. Related to volatility, Dan, what are we seeing out of implied volatility with the VIX?
Definitely some cooling off here recently. Still, certainly still elevated, which has kind of been, really the theme for much of the year is that, we have a, generally speaking, and a normal VIX situation where if we're, even if we're above 20, 16 to 20 on the VIX, that, you would expect to see some heightened volatility there. And really just, we haven't seen like the move in and out of that type of environment, if you will. We've kind of just stayed in this status quo environment for the VIX that,
grindy. Yeah.
It's just very grindy, very similar VIX environment to like that 01, 02, 03 time frame.
Oh, don't say that, Dan. Don't say that.
and but yeah, we've definitely certainly seen some cooling off of this week that I think more comes in the front of seeing some premiums start to liquidate a little bit, just coming over the summer. You talk about like put call ratios and stuff like that, but yeah, we'll see if it gives us that we talked about kind of that we want to see that capitulation type nature, which would from a thesis
we don't get it.
Yeah.
Like you said, I think it's a great example of, you look at 02, 03, how much further did we fall on, the major indices, and VIX works its way lower from, the mid 30s, basically where we're kind of capped out now. How about that? 30, this 35 level. And
well, what's interesting about this higher measurement of the VIX showing higher volatility, and I know he shared some work from David Annas, who does some work with the VIX, and just how when we look at the previous drops of the S&P 500 of 20% or more since the early 1900s, the average daily move to the downside is about 0.21%, whereas right now, like it's interesting because we have this elevated VIX measurement, but right now the rate of downtrend is about minus 0.13, so more than half less than what we normally see. And so it's this, I think you used the word before, Ian, grind. It's this grind lower that probably is frustrating a lot of people. For another way to paint it would be 15 of the previous 20 bear markets had one single day decline of 5% or more. And 4 out of 20 had a one-day drop of over 10%. The largest one-day drop in this whole thing since the beginning of the year is about 4%.
Yeah, I was gonna say, I think the worst day was about 4. Exactly. Yep.
And so you have this elevated measurement of volatility using the VIX, but yet it has been a steady grind lower, which is more indicative, if I can characteristically, to protracted bear markets, which means
Yeah, right. Because we talk about, right, and how, I mean, we talk about a lot on the team about, you play it for the bounce, you're gonna take the exposure of your bounce, and then you're gonna reset it for your shorts. But there hasn't been now May. I mean, I guess you could say that May, I don't know. There hasn't been the wild swings yet, upwards yet. I guess maybe in some of the individual names, but certainly not on the indices.
Right.
Just a grind both ways. There's been no puke moment where people just are like, screw it, I don't want to own anything. Now, some people also will say, well, look at all these individual areas like ARC. Like, are you telling me that people haven't puked up ARC yet? I mean, the chart looks bad, but then you look what are they've taken, they're positive with the inflows this year.
Yeah,
they've taken in like $3 or $4 billion more this year in that fund.
Yeah, there's still retail interest in that fund.
Yeah,
for sure. And maybe that leads us to some near-term positives, just that some of these former high flyers that have now been just decimated, the IPOs, ARC, SPAC, biotech, right now, over the last month or so, have found some relative support. Again, needing to understand that that's coming with it in the context of this bigger downtrend.
Yeah.
So that could be a near-term positive. That's something you would like, as we've said on here before, we just want to stop seeing things go down. And some of these
and you take like Roku, I'd say, Roku stopped going down in April, but it's also at the same spot it was, which is good. I mean, a lot of the ARC stuff, right? And a lot of the ARC stuff did kind of behave better during this last drawdown in S&P. Same with biotech, and we've seen both of those areas outperform.
For sure, yeah.
And then I would say the other near-term positive is when you think of index construction and what are the large pieces, Apple and Microsoft still holding up. Like, we need to, if we're going to see this correction unfold deeper, Apple and Microsoft have to have relative weakness, and we're not seeing that necessarily yet. We'll see.
No, Apple really reclaiming some good relative levels the past couple of weeks.
And so, speaking of bear markets, do we have bear markets in commodities and energy?
Yeah, down 20%.
Is that how that works?
It is. Yes, that's what they said in business school and on TV. And you think professors and media people would be wrong?
Can't imagine
Maybe one,
how that
but not both of them.
I can't imagine how that would be possible. That media and academia would be wrong.
I cannot confirm nor deny.
Right.
That was the question on the test. On the exam.
Yeah, exactly. Bear markets minus 20%. Who thinks of these things? But
yeah, we do. Crude got back below $100 for a little bit this week. I don't know if it's still there. Now it looks like we're back above 104. Got down to actually 90. Actually got down to 94 intraday, 94, 95. So I do wonder if, maybe does crude build a range out here for between 95 and 115? Maybe.
Yeah, could see. But there's plenty of... Go ahead, Dan.
No, and then we're kind of seeing, which is kind of interesting because we're starting to kind of highlights this week at least, some of that strength from like more of the clean energy, like your quote unquote, like if you want to call it.
That's a good point. Solar, all that did have a good week.
It's kind of somewhat of a mixed bag there when you start dividing that out and whatnot. But.
Well, and we have no hate towards commodities and energy because we participated in them, but they were also good sales. And
Yeah.
part of our risk management process for our clients is knowing when to hit the sell button, knowing when relative strength is done, knowing when absolute strength is done, and being able to hit the sell button, which is great. Like we can participate to the upside, not
Yeah.
to the downside. And I don't want to give any illusions here. I don't want to give any illusions that during this correction that somehow performance isn't somehow negative, but it's not negative to the degree that it could be if we don't have the ability to hit the sell button.
Yeah. I mean, you talk about XLE below 80 was just a no-go. It ended up falling down to 68, still sitting at 70. So you could see energy bounce here, but
And I think all these things get harder
back over.
if the dollar thesis continues higher. If we're above 104, which we could come back down and retest that, but if we're above 104 in something like DXY, that makes a lot of things harder, and including something we haven't even talked about yet, which is crypto land.
Yeah, crypto, Bitcoin still hasn't done anything, cannot get away from 20,000, 21,000. Trying to bottom out here, but you're right. Right? Because I have no value really for Bitcoin other than it's just something that's denominated in dollars.
It's like anything else. Oil's denominated in dollars, stocks are denominated in dollars.
Stocks are denominated in dollars. I mean,
aren't we just talking about a relative strength ratio between that thing and the dollar? That's all we're measuring.
Whatever it is, whatever Bitcoin is, whatever it ends up being, and I know it is something. We're not going to get all philosophical here. All intents and purposes of our process. Yeah, it's just, I don't know. It's just some currency that's divided by a dollar, some coin thing.
Yeah. It's something divided by a dollar.
I don't know what to tell you.
Yeah. When you go to the gas pump,
it could be called.
I'm waiting. I can't wait.
I don't know. Pigly
Pigly dollars.
It could be written in like a foreign language. I don't know. It's got a price chart. It's got a lot of price history to use, which is great.
Potty training coin could be that.
Yeah.
And really, in the end, like you go.
Connor's racking up PTC USD.
Yeah, potty training coin. I love it. I love that Connor's potty training. That's great. And he's dialed in. Like we've got.
I love it.
So we've got a trend in place, correct? Like for Connor, trend is in place. Okay. I love it.
In place.
That's great.
He's doing great. He's doing great with that.
Fantastic. And we see it everywhere we go, anything priced in dollars, right? If you go to the gas pump one day and it's $1.50, and you go there the next day, it's $2, and you go there the next day and it's $3, and you go there the next day, it's $4, you go the next day, it's $5. That's an uptrend in relative strength of gasoline versus the dollar. That's all that is. It's an uptrend. Maybe that uptrend is over. I have no idea. Or the rate of trend has changed. Now we see a flattening out of prices of commodities and energy, which we contrary to the narrative, right? We're just going to blow out inflation and everything's going to be higher a year from now. Maybe not. Because in the end, at some point, you have deflation. If you have tightening credit and you've got 3 asset classes, and now you could argue 4 asset classes if you include crypto moving downwards, that's deflationary. That's not inflationary. And so everyone talking about rate hikes in July might be one to think about rate drops, rate cuts in August and September.
Yeah.
We don't know. That's why we use price. So with that, we've bumped up against the end of the client portion. We should get the extended portion underway and then get on our market call. Anything else you guys want to touch base on in this client portion before we head to the end of the extended portion of the podcast?
No, I mean, still lower lows, lower highs. I mean, until that changes, you got moving averages and everything are down. The rallies are fun though. They're fun to watch.
The grind continues.
Yeah, the grind continues. Keep grilling. Yeah. Just with this environment and risk management in place for our clients, as Dan likes to say, relax, enjoy your summer, and grill your meats because we've got the risk management under control. Cash is a position too. We're willing to use that. The current environment continues to be lower highs and lower lows, the very definition of a downtrend. Even like Ian said, when it feels good, when there's a week that's up, that doesn't mean we're out of the woods. So with that, I hope everyone had a fantastic celebration for their Independence Day, which is a great thing to remember and reflect on, that we live in one of the greatest countries in the world and live free. That's a fantastic thing. Otherwise, I hope you guys stay on for the extended portion. We'll talk semiconductors, transportation, healthcare, and medical, a couple of currency things. Take care.
Have a great weekend, everyone.
All right, gents, jumping into the final portion of the podcast. We won't take too much time. But if we're to think about some bellwether areas of the market that kind of give us clues on what's potential or what's potentially possible, what are those areas and what are we seeing out of them? Don't all jump at once.
Well, you got obviously Michael or Microsoft and Apple.
Microsoft, is that our competitor brand? Microsoft.
We talk about those. We know everyone and their grandmother knows that those are. Exactly what you said before. If we're really going to do this, both of those are going to have to fall apart. I don't know, semiconductors.
And what's going on with semiconductors?
They still look pretty bad. The Micron reaction was right. They gapped it down the next day, but the reaction since then was pretty good. I'm still not. It's still below $60. It looks like to me. Relatively, they certainly haven't done anything great, right? These are not. You look at SMH. I don't know if it's filled either of its gaps. Okay, we did today. Just today, we finally filled that gap from what is? Oh no, we never filled the June 13th gap.
Well, I think using SMH versus the S&P is still important, below important levels.
That's a bad rally. That's a really, given what the broad indices have done, that's not a great rally for semiconductors.
Yeah, SMH is still below on a relative basis, still below important levels. And that's what we would call a distribution type pattern that goes back all the way to November of 2020. That's a massive potential distribution that took place in semiconductors, which is a risk-on area of the market. Another piece of evidence for a corrective market. Dan, how about transportation? What are we seeing out of transportation stocks? You could go individual, if you want to talk FedEx or any of those, or you could talk about it overall. But are we seeing any, hope's not the right word, are we seeing any evidence of potential risk on out of transportation?
Not really. Just looking at kind of.
I love that. That's good. We could even end it there. No, keep going. No.
You just look at, like you said, at FedEx, not really giving you, hanging within the range, nothing really too inspiring, I guess, there.
And that's kind of been the best behaved transport stock, hasn't it been?
Yeah, at least from the sense of not
like a relative perspective.
Yeah, exactly. Yep. But then, you look to even kind of go a little deeper of, the one we kind of like to talk about, it seems like kind of the team is like that Starbulk, SBLK, not really seeing.
Yeah, those shippers fell apart, didn't they?
Some of those shippers and whatnot. Just not really seeing the bounce that some of the broad market has even seen this week, I guess. So
zero bounce out of that. You're right.
But, so the digital trains, semiconductors, and the literal trains, transportation, really not seeing any type of accumulation. Even if we look at Union Pacific,
not horrible.
Trucking's not bad. What do we look?
Okay, I say that. I know I've got Old Dominion pulled up in front of me,
which is that's the Cadillac, or I shouldn't use that. That's the All-Star.
That's an All-Star in trucking. If I look at a couple more,
down.
The others are not. Yeah, the others are not as if you look at Saya or you want to look at JBHT. Yeah. Which is fine. Old Dominion looks great. I would expect it to look the best of the best, but
what about the other? What about the other? Because I know railroads are kind of a big part of this, but I know we were talking Union Pacific, not great.
Yeah, Canadian Pacific. Looks rising wedgie to me. I mean, if that goes,
Rising wedgie sounds like a terrible initiation process.
Somebody's getting one of those at Kevin's bachelor party.
Yeah, I mean, if this breaks 67 now, I mean, it's bounced there, right? It's got to do it. Yeah, transport's not showing too much or getting too much love there. It's really been this small cap growth stuff this week.
That's shown some positive characteristics.
Yeah.
Yeah.
And biotech, and but you throw biotech in there.
I was going to say,
right. We talked about earlier. Well, we know banks have been lethargic. We know energy's gotten creamed. I mean, where would the Russell be without biotech doing what it's doing? And right, maybe for that's a silly game to play because, I mean, it is doing what it's doing, and biotech is a big chunk of it.
Well, I know.
But
in the medical space, in that healthcare space,
yeah,
Dan found some things with, if you want to use something like XHS, like healthcare services.
Dan's been real big on the healthcare.
And it is interesting to see biotech kind of rebound here, but those are two different things that I'm talking about here. I don't want to put healthcare services in the same boat as biotech, because biotech definitely is in the counter trend bounce category. Whereas there might be some things out of healthcare services that are showing positive characteristics. We'll see.
Yeah, a lot of work left to do, I'd say. But yeah, I mean, you're kind of starting to see some, at least like some, what do you consider like intermediate, higher highs, higher lows, like maybe shorter term to intermediate, maybe not even intermediate actually, but shorter term at least.
Okay. So I know one big breakdown we had this week, and I don't have a good way to segue to this. It's just we saw the euro breakdown versus the US dollar. And this goes back to we continue to see dollar strength. It's a theme, it's a thesis, but it's a relatively big breakdown in something like the euro USD. And if you're looking to take a trip over to Europe, now might be the time.
Yeah, as I say, we're about to be back at parity.
Yeah, I mean, almost
about to be back at 1.000.
And so maybe now's your time.
Or if you're a risk taker, maybe put that vacation off. You wait another year, and now you're going even cheaper.
Well, yeah, because I mean, we've broken the 1.03 level in that currency pair, pretty big. And could you see it where we're in the late 90s level, where we're at 85 cents, or
tell your wife. I know you got who's all you guys out there. You got your big anniversary trips planned, your big trips with your wife. I think you can get her to put it off a year if you just tell her, as long as the euro stays below parity. Below parity. Like, tell her all the extra things you're going to be able to buy when you go, all the extra nice shopping she can do.
Yeah, babe, we got to wait till we're at, spot 8.5 in euro USD before we go.
Now then, if it rips the other way, then then it's a double whammy. Now you're waiting a year, and you're staying at the Holiday Inn Express.
Yeah, this is like Dan's mustache type.
You're eating at the McDonald's in Rome, and
you're taking serious.
Yeah, it's a risk. I mean, you do what you want. It's your call. It's your call. You can judge your marriage on how things work, but I'm just saying, if you wanted to even wait.
Yeah, it's a big boy position. It's a big boy position, and it's. I mean, it can't be as controversial as facial hair, but we'll see.
Touchy subject.
I know. Regrow it overnight. Be like Homer Simpson, man. Just do that deal. So I kind of teased this at the beginning. We should probably talk about it a little bit. And we've been overly bearish is not the right term, because it's just evidence that we have at hand. What do we need to see? Like, if we're going to come out of this, if this is the bottom, how does this work? What do we need to see? What levels need to stabilize, or what do we need to reclaim for this downtrend to be over? What do you guys think?
I mean, S&P, I would say 4150, 41, above where we peaked out in late May.
Yeah, it's a huge level, man.
Early
huge behavioral level. Need to reclaim that 4165 and something like the S&P 500. Dan, how about you?
Yeah, I mean, that's a great level. I do love that level in terms of not emotionally, but just like seeing it, especially because you had that consolidation there.
No, you do love it. I'm going to tell Dana.
Please do. She'll be ecstatic. Especially, yeah, because you had that consolidation around there that was kind of like, I mean, that's what led to that. Was it 3 or 4 days of the breakout where it was like, you recover there, could be in a completely different story. But anyway, yeah, that inflection point around 4,100 to 4,150, 4,200, let's call it. I would like to see like a mixture of like the dollar chilling out and then, I don't know, like some sort of capitulation. I know it doesn't need to happen, but like just some sort of capitulation, I think would be another.
Yeah, your point about that is just we've grinded lower, seeing some type of bigger move to the downside might mark that final piece of like people throwing up their hands and giving up.
Right.
Some type of acceleration, in which what we do see in corrections is there is the final piece is an acceleration to the downside, which we really have not had. I'd also argue something like the NASDAQ 100, if we use a VWAP, VWAP, whatever you guys want to call it, around 313. That's the VWAP from the COVID lows on QQQ. I think of IWM has a lot of work to do. That would be around 186 for that. We've talked about the 190 level on here.
I was going to say, or even, I mean, for it to truly be over, you got to get up above 210.
Right.
Right. And that's right. And now you can't necessarily wait for that, but
well, correct, because
that would be the final.
Now you're getting to the point in the correction where the correction is deep enough that the likeliness of a base or a stabilization needing to take time increases. Yeah. So yes, I know we've had V bottoms. I get it. But as your downtrend gets larger, the amount of time it takes to build a base for equilibrium to take place where it's not just continuous selling or to provide selling exhaustion, there's got to be a base that gets built. And something like IWM, could it stay, in between 188 and 165 for a few months before basing and moving higher? Absolutely, it could. But right now, the evidence suggests it could be even moving lower. We don't know. So I appreciate the levels you guys highlighted. Anything else you guys want to touch base on before we close this thing down?
No, nothing on my front, I guess.
Nope.
Yes. Nice job. Nice job, fellas. We appreciate everyone that's listened. Appreciate our clients. And we wish everybody a great weekend. We hope you enjoyed the shortened week this week. But like Ian highlighted this morning, we'll be back at it on Monday. It feels like we had some good holidays here, but now we enter a stretch where we don't get a Monday off. And that's okay. We'll enjoy it. We appreciate everyone listening. Take care.
Have a good weekend, everyone.